On today's hot sheet, I'm discussing the producer price index for October and what effects that has on inflation, the NAR chief economist's 2025 predictions, and weekly unemployment. Today is Thursday, November 14th, 2024. I am Byron Lazine, and the hot sheet starts now. Welcome into the hot sheet. Let me know which market you are tuning in from. I am live today from Nashville, Tennessee. I'll be here next couple days before I head back to Naples. Hope everybody is doing well. I see Dawn in East Texas. Dawn, your X account has been on fire lately. I see you out there. OKC, Jody, Jim's in Western Upstate South Carolina. I just left South Carolina last night. Seattle, Laura. So nice to see you here. Hope everybody's doing great. We've got a bunch to go over, so let's jump into it. And we've got PPI news first leading off here today. And Haley, I know you're in the background. So as I go through this, since I don't have my switcher, you could share the details, the PDF released from the Bureau of Labor Statistics here for the PPI. The PPI increased 0.2% in October. That's seasonally adjusted. And the U.S. Bureau reported this morning. Okay. Now, big news here on this is the wholesale prices are in line with expectations. So much like we saw yesterday with CPI, we see another inflation report that meets expectations. So that decreases the chance of volatility, of the R word creeping back in. So while they did nudge higher in October, this higher move was expected. Remember, Jerome Powell said last week that he expects there to be some short-term moves higher as we kind of roll off of the calendar end of 2023 numbers, which were much lower, which had people with the false belief that the 30-year fix and the 10-year fix, or the 10-year yield, rather, these long-term rates would drop precipitately in 2024. Obviously, that did not happen. So this measures what producers get for their products. Okay. The 0.2% for the month is up 1/10 of a percentage point from September. And so I don't know if Haley, if you've got those charts there. There we go. Thank you, Haley. This is the last 12 months here. As you can see, October, November, October of last year coming in lower. So as that rolls off, you do see an increase here on the annual 12-month percent change up a touch here from September to October. You see that in part two. Chart two, excluding food and energy, the core PPI rose 0.3%, also 1/10 more than September. That also, though, met expectations. So both numbers are meeting expectations. The 12-month rate, when you exclude food and energy, running at 3.1%. So exclude food and energy, and you've got 3.1. That's 1.1 higher than the 2% target. Now, the PPI producer price index is not the Fed's main target as they look at PCE. The market, which we reviewed yesterday, looks more so at CPI. CPI was also up, but up in line with expectations. You can go back, give that a listen here on YouTube. If you're getting value, by the way, out of the hot sheet, go ahead and hit a thumbs up and subscribe to the channel. We also have those replays available on Spotify or Apple. So if you prefer to do replays over there and you missed yesterday's, you can go check that out. Services rose 0.3% on the month, counting for the most in the PPI increase. Was driven largely by a 3.6 surge in portfolio management prices. A lot of people are also probably looking at their portfolio right now, given the last couple of weeks. I know that's more so November talk, but certainly portfolio discussions, stock discussions, Bitcoin discussions. Check out the article on nowbam.com this morning if you want to get a laugh about a Bitcoin offer that was made to one of Ryan Serhant's listings. Hilarious article, but a true article on where Bitcoin prices have gone with that increase. Fascinating stuff. Food prices also fell 0.2% in the month, while energy was off by 0.3%. Good prices nudged a little higher by 0.1% after falling the previous 2 months. Stock futures so far didn't have that big of a reaction, while Treasury yields held higher. Okay, so, and Haley, I'm not sure if you've got the 10-year pulled up. If you could go to that screen, we are looking now at a 4.41, 4.418 on the 10-year Treasury, 4.14 there, as you see on your screen. If you look at the, Haley, if you just click 1D, the 1 day, you do see a spike as this news came out, and then we've kind of come back down here as of where we sit here today. So 10-year Treasury now up over 4.4. Yesterday, the 30-year fixed did go down to 7.01, still holding a 7 handle off of the 7.02. And this is, as you saw throughout the day yesterday, a 10-year that, I mean, we started the day yesterday in that high 4.38 range. And then throughout the day, it got back up over 4.4. And as mentioned, it is holding there with this news. Markets opened up a little bit. Dow, S&P, and NASDAQ all open up just a little bit. And obviously, again, 10-year it was up, now coming back down, but still up over 4.4, which probably means a hold on the 7 handle here today. Traders do expect the Fed to follow with these rate cuts that we've had in September and then now in November, in December. Okay, so we have an 80-20 chance, 80% chance that we do see a quarter point cut according to CME Group, 20% chance. It's down a little bit from yesterday, but after the CPI, we saw that number shoot right up from about 60% to 80% on the next cut. Okay, Lawrence Yun, moving over now to housing predictions for 2025, has released his. Lawrence Yun is obviously the chief economist from NAR. Has a great, love to have this job. You hear from him about once, maybe twice every month. And, we do this hot sheet every single day that the markets are open Monday through Thursday. But Lawrence has got himself a nice cushy job. He's got a lot of data coming in, so he has a huge advantage there. And he's released his expectations. Okay, so let's start with home sale projections from the NAR chief economist and where he sees home sales going. Sales are what most agents are going to pay attention to, as that is the fuel for the market. That's what keeps things moving, more transactions, more people to help achieve goals of home ownership or move on to that next home. And Haley, if you can pull up the article there on nowbam.com, you see, and just zoom right in onto that, 2025 home sale projection. Existing home sales, Lawrence has a 9% year over year increase. So 9%, you're talking about, potentially, if we're trending closer to 3 million on existing home sales, then you're talking about 300,000 more. If we're trending towards 3 million. If we're trending closer to 4 million, which is probably going to come in just under that, that could be a swing on 400,000 home sales on existing, which would be certainly, you double that on sides, 800,000 sides, significant right from where we are. Obviously, we're tracking for the worst year since 1995 on existing home sales. 9% would be a move in the right direction. Love to see it, obviously, in double digits. New home sales, Lawrence Yun does have in double digits at 11%. Now, moving forward 2 years, existing home sales expected to bounce in 2026 to 13% year over year, while new home sales expects to increase, but not at the same rate as 25, only at 8%. As we go to Lawrence Yun's quote here further down in the story, homeowners' wealth steadily rises while renters' wealth does not. If you do not enter the housing market, obviously. So there's like a, anywhere from a 45 to 75 times gap between homeowners and renters when you talk about wealth. If you're in the renter class where wealth is not being accumulated, obviously you have that disparity between homeowners. If you want to participate in the housing market, the sooner you get in, the sooner you accumulate wealth. I would just add to that, as long as you stay in the home 10 plus years, because there can, like in any market, be expenses, obviously, and volatility that come with that. When we go to median home prices further down, 2025, chief economist here from NAR does see a increase on median home prices. 410,700 is where he sees median home prices coming in for 2025. That'd be 2% over 24. So getting back to more stable or a more, average to below average growth over the next 2 years, 420,000, a little Elon Musk number there in 2026, plus 2% for 2025. The strong price increases cannot be sustainable for another 5 years, claims the chief economist here from NAR, or America will be divided. I'm not sure that that's the reason. I mean, that might be an outcome where you have more of a wealth division, but that's not the reason why home prices are not going to go up because of some division between American. Like, I don't know what he's calling for there. With only few getting to experience a tremendous, like, I'm in agreement there. Yeah, I don't want to continue to see homes get, as unaffordable as they've become, but the strong price increases are not, it's not that they can't be sustainable for another 5 years because of that division. It'll be, they can't be sustainable for another 5 years if Americans can't buy homes, right? Like, the division has little to do with it. I don't know, it's kind of a weird way. I'm kind of parsing words here, but if we bring more supply to the housing market, home price increases will not be as outrageous and they will be in line with wages. Yeah, we want to see more supply. That being said, with some of the projections and obviously investors looking at this economy right now, very bullish, and you can drop that off there. We'll go back to his mortgage rate predictions here in a second, but investors are very bullish on this economy right now. And there's been some talk of like the economy growing at numbers that we just haven't seen, 6%, 7%. I know these are very bullish numbers, and I'm not projecting that at all. But if that were to happen, and you see wages grow, you could see, home prices continue, assets certainly continue. There is some, the more bearish cases on the new administration plan would say that, hey, you're going to borrow more money, and that also could push up asset prices. So there's a few cases out there to see where, like, hey, home prices could go up more than the 2%. I'd love to see prices stabilize and more inventory come on the market. Like, I'm in favor of that. And then the facts of like what is actually going to happen is a whole nother story. We go to now mortgages there at the bottom. Haley, mortgage obviously have ranged from 6.08 at the low. We just saw that recently. As recently as September, about a month ago, or 2 months ago rather, to as high as almost 7.5. Mortgage rates in the first term under Trump were at 4%, and those are now the good old days. Are we going back to 4%? Per my forecast, unfortunately, we will not. It's more likely that we'll go back to 6%. That will be the normal, bouncing around 5.5 to 6.5. If we have a bounce around to this prediction in 25 between 5.5 and 6.5, I think everybody takes that. I think you would actually increase that existing home sale prediction, into double digits. That was at 9%. I just think that there's that much pent up demand if you're averaging basically 6 throughout the year, and we've seen that as we get closer to 6 at times, that pent up demand really does present itself. Moving over to unemployment, also just released this morning for the week ending November 9th. Initial claims were 217,000. You can show that first chart there. It's a decrease from 4,000 from the previous week's unrevised level of 221,000. 4-week moving average is 221,000. That's a decrease of 6,250 from the previous week's unrevised level of 227,500. And as we look from, the last 12 months, there has been a slight tick up in unemployment. And, if we get any increase in that, you can stay up on the top one there. That shows the first chart. There you go. That does show that increase. Moving up on the unemployment from, we were in the high 3s to now got up to, almost 4.3 at one point, now 4.1% on unemployment. If we see an increases here, that would help the long-term rates, the 10-year and the 30-year specifically. Not rooting for people to lose jobs, but that certainly would be one of the outcomes from a softer labor market. There are many believe that we won't see a 30-year fix really get under 6% unless we see that. Okay. All right. There you go. There's your hot sheet for the day on your 24-hour look back on the macro elements of the housing market. If you're getting value from what we're doing here at BAM, subscribe to the YouTube channel. And if you want the access to the fastest data, like our hot sheet show notes, as well as the charts and done for you content every single Friday, make sure you jump into BAMX, use code HOT today to get your access into BAMX. You also, with that now, have a platform for Zudilio completely included in. Zudilio helps you get more listings. You can generate 4 listings for your sellers using Zudilio. So many BAMX members are already seeing the benefits of what's happening with that incredible tool. All comes with the BAMX platform. Use HOT today to get into BAMX at the lowest price available today. Jody, thank you. Marissa, thank you for using those show notes to be an agent of change and close the knowledge gap that is certainly out there and separate this industry from the marginal agent that we were all warned of 10 years ago and unfortunately still exist today. So that's your week for the hot sheet. We'll have a Knowledge Brokers pod over on Knowledge Brokers channel tomorrow. Also here on the main BAM channel, there will be a walkthrough pod, I believe, later today. There should be. And I am going to head over to Gary Ashton's office here in Nashville. I'm going to see a few things from one of the masters of our industry and excited to do that. Hope everybody has a great day, and we'll see you next time. Until then, toodaloo.